Hello, chart watchers, and welcome to this Wednesday, May 23rd Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the action today, you can see the Dow Jones Industrial Average under pressure. Big reversal yesterday, as you can see, bearish engulfing candle. That normally signals some short-term weakness, and we're getting that today. Dow Jones down 145 points. The S&P 500 continuing to move sideways in flag formation, down 10 points today. The NASDAQ gap down is up off of that earlier low, but still down 11 points. Russell 2000 on a relative basis hanging in there very strongly. That also had a bearish engulfing candle, suggesting some short-term weakness. We saw it early in the session, but the group has rebounded pretty nicely. 10-year Treasury yield, big move to the downside, down almost 5 basis points, 3.02%. We'll talk about some of the numbers that came out this morning, economic news. Volatility surged earlier in the session, got up into the 14.5 range. It has settled back down, though, currently at 13.73, up about up about 51 points, or that would be roughly 4%. Utilities having a pretty strong day today, along with consumer staples on a relative basis. These are the two groups leading today. Financial struggling. We'll talk about this in a bit. They did have a false breakout yesterday in the gap resistance zone. Right here, you can see that tail where it tried to get back up above prior highs, failed, and it is now moving lower. Full line insurance companies really struggling within the financial space. You can see here on the chart, big red candle so far today. A couple of bright spots, clothing and accessories having a very strong day today, as well as apparel retailers. Some excellent earnings reports out in that space, and we'll talk about that in a bit as well. But for now, let me bring in my co-host. Welcome back, my co-host, Erin. I hope you had a great trip, and happy Wednesday.
I did. I had a very nice trip, unplugged, no Wi-Fi up in the mountains, and we loved it. We took the dogs on some open trails so they could run around. We didn't see anybody. We just spent the entire time hanging out in the cabin and enjoying the rain on the one day we had, and lots of fires. It was really fun, very enjoyable.
The only dogs I had were in the stock market yesterday.
Yeah.
But my Caps won.
Yes.
Caps won on Monday, my birthday. They didn't fail me.
I know they're going to the Stanley Cup Finals.
No, they're not. Not yet.
Not yet. Oh, that's right. You still have one more.
Game 7 tonight.
Yes.
Game 7 tonight. So we'll see what happens tonight. But at least they didn't ruin my birthday. That would have been horrible. So we're still good. But we do have a special guest with us today. David Keller is returning. And how are you doing this morning, David?
I'm well. Thank you, Tom. Aaron, good to speak to you both. I'm a Boston Bruins fan, so I begrudgingly acknowledge the strength in your Caps, and I wish you well tonight.
Thank you so much. Well, I think the Bruins have had the upper hand over the Capitals for most of the past 4 years.
Right.
It is your turn, my friend. Enjoy it.
I hope so. We'll see. But I know when you were on a couple months ago, the S&P 500 was languishing near the 2,700 level, and it's still languishing around the 2,700 level. So it'd be interesting to see what your take is in just about 15 minutes or so. So stick around with us, please.
Sounds good.
And with that, Erin, I'm going to let you get into the schedule and the agenda. We'll get this thing going.
Yeah, absolutely. So Friday, we have everything stock charts coming up. Of course, Monday is a holiday, so we won't be broadcasting. Tom has a workshop coming up on Tuesday of next week, and I'm sure he'll be taking your survey comments to determine what it should be on. So be sure and send those in. And then Mark Chaikin is going to be with us on Wednesday. Very exciting to have him back on the show. But with that, let's look at what we're going to do today. As Tom said, David Keller's here. He's going to give us a really interesting presentation. 10 in 10, Motorola Solutions is going to be our first symbol, MSI. And then finally, we're going to do our segment Inside the Lines, pitting fundamentals against technicals. And with that, I'm going to pass it back to you, Tom, for the technical headlines and news. And let's go.
Sounds good. 10-year Treasury yield down, as I mentioned earlier today. We're testing that rising 20-day moving average. And you can see over the past 5-6 weeks, that has been a pretty good area of support. So we'll see whether or not the 10-year Treasury yield stops the bleeding at 3%. We did have a couple of economic news reports out this morning. Hadn't seen anything the last 2 days, but this morning We had May PMI composite flash came in at 55.7. That was better than expected, which was 54.8. But then the April new home sales came in worse than expected, 662,000. The market looking for 677,000. So perhaps the weakness there with the new home sales triggered some of that selling. And to be honest, I think some of it is just the fact that we were so oversold in the bond market. And so we're getting a bounce in bonds. And of course, the yield moves opposite. It moves in opposite direction to the price of bonds. So with the price of bonds bouncing, we've got the yields falling today, but not a horrible thing. Continue to remain in this uptrend. And I think overall, that is what I would expect as we move forward. Taking a look at what's going on today, there's a lot of earnings reports. I'm going to hold off some of the commentary there, though, for later during Inside the Lines. So I think what I want to do here first is just take a look at the sector summary so you can get a quick feel for what's going on in the market. It's not unusual at all when you have a little bit of profit taking going on in the market for the defensive stocks to jump to the leadership, because many of the stocks that generated the recent gains in the major indices are the more aggressive stocks that we find in the financials, industrials, technology, and so forth. And that's what we see down toward the bottom of the leaderboard. So we are giving back some of those gains recently. I noted the financials were lagging. And if you look, the defensive areas of financial, the REITs, they're all up today. But once you get past the REITs, everything turns negative in the financial space. Full line insurance, as I mentioned, having the roughest day of all. You can see a chart here where it came back up, tried to get through the late April high, failed. Now it's going back down. We did get a recent golden cross, though, with the 20-day moving up above that 50-day moving average. And as we move down, we're testing that rising 20-day moving average. We're almost sitting right on the 20-day. So this will be an interesting area. Also, I had done a correlation chart looking at the full line insurance companies, and very similar to life insurance and the banks and so forth, the relative strength of the full line insurance index relative to the S&P 500 tends to follow the direction of the 10-year Treasury yield. And this correlation down here at the bottom is the evidence of that. If we look back over the last 8 years or so, you can see that for the most part, we remain in positive correlation territory, meaning that when the 10-year Treasury yield's rising, we tend to see the full line insurers outperform the S&P 500. And if you just look at the chart without looking at the correlation, I think that's kind of what you see. Here's the relative strength of full line insurers relative to the S&P rising in 2012 and 2013. And that coincides with a nice little spike in the 10-year Treasury yield. And then as we go down in the Treasury yield, we pull down, go lower in the relative strength. We get a spike in the yield, we get a spike in the relative strength, and so forth. But what we see now, if you look back to, I'm going to say around the October timeframe of 2017, you can see that the relative strength of the full line insurers was dropping along with the 10-year Treasury yield. But look at the 10-year Treasury yield storming back, and look at what is going on with the relative weakness in the full line insurers. And what that has caused is a negative correlation, which is very unusual, as we got down about to the low point that we saw back in 2014. And if we look at what was happening in 2014, I think you'll see that the relative strength was kind of flat, even though the 10-year Treasury yield was moving lower. And then all of a sudden, the relative weakness took over and we started to play catch up. And from that point forward, we started moving back positive correlation. So anytime we see this unusual negative correlation here, I think one of two things. Either we're going to see a rather significant drop in the 10-year Treasury yield, or we'll begin to see outperformance of the full line insurers relative to the S&P. Today, what's happening is we're seeing that 10-year Treasury yield fall. I don't know if that's going to be the case going forward. I actually expect to see this relative strength line maybe move back up above the 20-day moving average. And I could get rid of the candlesticks. Candlesticks with relative strength tends to make things a little harder to read. But here you can see we continue to trade beneath this 20-day. First sign of a reversing kind of a market here in terms of the full line insurers would be to get back up above that 20, similar to what we were doing back in 2012, 2013, where the relative strength stayed above the 20-day. Right now, we're below that 20-day. So something to watch for and keep track of. go back to that page where we've got the sector summary. I'm going to pull up the industry summary. Couple of things I wanted to show you. First of all, within consumer discretionary, take a look what's leading. Clothing and accessories up 2.5%. Apparel retailers 2.25%. Home improvement retailers 172. Specialty retailers up 1%. Kind of getting a feeling that the retailers are hanging in there pretty nicely. At least that's what it looks like to me. Now, as we go out, I'm going to pull up another chart, and this is where I have my S&P 500 components. So everything is listed in all the S&P 500 companies are in this folder. And if I go to the view list as and pull up summary, you will see it should be in percentage change order. There you go. Take a look at the top performing stocks in the S&P 500 and look at the industry groups and the sectors. So you've got, for the most part, consumer discretionary leading the S&P 500 with many of these retailers just littered on the top of the S&P 500 leaderboard. Many companies that we'll talk about later with earnings, but Tiffany, Polo Ralph Lauren, RL, Lowe's companies, home improvement retailer. This one was really interesting because they didn't, from what I saw, their report wasn't that great, but the reaction, check out the reaction, 9.6% to the upside. I'm going to challenge Erin later in the show and see what she thinks of Lowe's. But you can go right down the line and take a look at all of these retailers that are up at the top of the S&P 500. So clearly this is a good day for retail. Let's take a look at some of the intraday charts. I'm going to pull up the Russell 2000 first and look at the daily chart, because yesterday we put in a reversing candle, a bearish engulfing candle. Now, I don't look at this necessarily as a long-term signal. Many times you pull back for a day and then we could take right back off. Keep in mind that when you get these reversing candles, a lot of times what it means is that you've got market makers, which maybe are on the short side. They're basically selling into just about anybody who's buying, and that's what triggers a lot of this sell-off. So many times it's just a short-term thing where we pull back, and given the strength of the PPO here, I do think this is going to be a short-term pullback, but the question is, how far might we go off of this uptrend to pull back to test? I would say maybe 1,600. We've got the 20-day moving average right now, 1,598. You've got a recent low here at around 1,590, and you can see a couple of highs coming in here at about 1,590. So I think 1,590 to 1,600 is an area that would be pretty attractive for entry into the small cap stocks if, in fact, we get a pullback that goes back that far. Let's pull up the hourly chart and on an intraday basis, check out what's going on. At the most recent high here, higher prices. Yesterday, we were trying to break out above 1640, but look at the PPO rolling over. We came down today and actually got that 50-period test, very similar to what we saw back in mid-May. If you check out the higher prices, see how we had been trading above that 20-hour EMA, just like we had been trading above the 20-hour EMA for the past week. But once we got to a point where prices were rising and the PPO started to roll over, same thing goes here, PPO rolling over. We immediately had a day, or well, in this case, 1 day of correction. So far, we've had one here into this morning when the sell-off actually began yesterday morning. So it's been roughly 24 hours. But now the question is, do we hold the 1620 level? If we fail to hold it and we move back down, I think there is a chance that we go back down to about 1590 to 1600. And that's where I would look for maybe a little bit more buying to come in on the Russell 2000. So something to keep in mind there. Also mentioned yesterday, or actually I think it was this morning in my blog, one area of the industrials, which really struggled yesterday. And I'm going to annotate this chart because I did not like the action here. And if we pull up the trend line that this has been under really since back in early February, and just kind of go across this line here, you can see all of the tests of this downtrend line that began back in early February. You can probably count them with me, but there looks like about 7, 8, maybe even 10 tests of this trend line. When you get a trend line that has that many failures, you have to respect it until you get through. Yesterday, or day before yesterday, we hit it, came back down with a very bearish candle. I was starting to look at this chart thinking, well, maybe, PPO is just starting to cross the center line for the first time in about 3 or 4 months. And I saw this trend line. I was like, we need to get through the trend line. And instead, we printed this bearish candlestick, red filled candle. Look at the volume pickup yesterday on the selling. And now we continue down again. It certainly appears to me like we're going to go back down and retest this 415 area on the heavy construction stocks. A couple more charts, and then we're going to turn it over here to David Keller. I wanted to mention the financials again, the XLF, because on this chart, and actually maybe the best way to do it is go ahead and pull my blog up because I've got that already annotated. Here is the chart, and I'll put it in real time. But here is your overhead resistance connecting the highs. So we figure somewhere around the 29 level, we've got some overhead resistance. And then we've got gap resistance that shows there with the red shaded area. Notice yesterday's high. We took out the high from back in earlier in May, and we also took out the intraday high on this gap. So it looked like yesterday we were making a breakout. And then by the close, we saw the whole market reverse. Financial still led on a relative basis, but I did not like that reversal and failure to close above these two highs. So short term, I was looking for the pullback. Now here's where it gets pretty interesting, because in the short term, we've got a PPO that's now gone bullish. And when we start to accelerate in bullish fashion above the center line, I start looking for 20-day tests as the area for a pullback. If you noticed when we were rising back here in September, October, and we pulled back, where did we pull back to? The 20-day moving average before we went to a new high. When we accelerated in December to the upside and the PPO went higher, when we finally pulled back or sideways consolidated, we held the 20-day before we went higher. So if you're treating this as a move to the upside, which I am, I think it's pretty important in the short term that we hold this 20-day moving average. That's 27.95 right now, and we're currently at 27.97 on the XLF. So we need to see another surge to the upside in the banks, the life insurance companies, the full line insurers, some of the things that we were just talking about. We don't want to see the REITs leading to the upside. We want to see the more aggressive areas within the financials leading, and we'd like to see this XLF hold the rising 20-day moving average. So that's something to look for. Last chart I wanted to pull up here is the DJUSAM, which is the medical equipment stocks. This, I'm going to go back a little bit further here. Let's go back just a year. And I think you'll see that clearly we had made a huge move in January, while the overall market, I mentioned the S&P 500 still languishing. Medical equipment stocks are trying to make a pretty big breakout here above this 1520 level. And I still think can continue to trade very bullish fashion, even with the market down today. You can see this is a group that is performing pretty well. And one stock that I wanted to mention in this group, and I'm going to pull it up in two ways. First, using the relative strength chart. This is ISRG. ISRG back here reported great results, huge move higher on heavy volume. Notice the hammer that printed right at gap support and the 20-day moving average, went all the way back up, put in a double top, and I think just consolidating right now. But if you look at the group trying to make a breakout, and then you look at the overall relative strength of ISRG relative to the medical equipment stocks, I think it's been in a nice long uptrend, just pulling back. But normally what these pullbacks mean are normally a push to the upside. We saw it earlier back in December where we pulled back relative to the peers, and then ISRG took off. We saw it again in March into April. ISRG took off, and now we're pulling back. So this could be presenting a nice opportunity. You can see ISRG has been a great performer relative to the S&P, and so has the medical equipment group overall. So that's one thing I like about ISRG. The other is seasonality, and we'll be talking about seasonality again pretty soon as we head toward June. But if I pull up the seasonality chart on ISRG, and then let's scroll back, look at the relative, well, just look at the average returns, the actual average returns during the month of June and July for ISRG. 7.4%. ISRG has averaged moving up 7.4% in the month of June, 11.8% in the month of July. over the last 19 years. Now, that means this stock has gained on average almost 20% every June and July for the last 19 years. Now, it's an average. Doesn't mean that it happens every year, but it's certainly worth keeping in mind as we go forward. With that, I'm going to bring in our special guest, David Keller. David, you were with us a couple months ago. The S&P 500 was just kind of languishing. It's still languishing. What do you got for us?
Thanks so much, Tom. I, as always, enjoy watching your recaps, hearing you talk through things. It's interesting with the markets. I've always told people that remember, the market can go three directions. It can go up, it can go down, it can go sideways. And we love to simplify by thinking up versus down and bull versus bear and bullish versus bearish and all of that. But in the end, a lot of times markets don't go anywhere overall, even when they have elevated volatility. So you have a situation right now where the markets, even with the movement, even with the volatility, have essentially gone nowhere. They've been sideways. And that can be okay because if you're looking at groups or sectors or individual stocks, there are lots of opportunities to differentiate. And I think if you do active management, if you're stock picking, then I would argue that this is a better environment than we've seen in a long time, because there are stocks such as some of the ones that you highlighted that are seeing new highs. There are stocks that are seeing new lows, and so there's opportunity.
Yeah, no doubt about that. I mean, we've seen some of it, and I don't know if you're planning to get into it, but maybe at some point later we can. But certainly we've seen a lot of strength in the dollar, and maybe that's funneling some money towards small caps and so forth. But we're going to talk about that a little bit later in the program. I want you to go through and highlight your presentation first. And by the way, anyone out there listening, if you've got questions, type them in the chat box. Erin's going to be monitoring that chat area, and we'll pass your questions along to David as we go through the presentation.
Indeed.
Sounds good. Thanks, guys. So everyone, a pleasure to join you again, and very good to be back. Last time we talked about the different, functions or the different qualities of technical analysis. They can be predictive, they can be comparative, they can be descriptive, depending on how you use technical analysis. Here, I wanted to dig in a little bit more into some of the behavioral reasons why charts work. And what you'll find if you follow any of my blog posts or my research is that I only tend to use technical approaches that I feel have a good backing in behavioral finance, meaning the behavior of investors making buy and sell decisions, and a lot of times making poor decisions with their investments. A lot of times is what creates the patterns that so many of us have found profitable over time. So I like to use things where I find that the validation is in the theory of investor behavior. Before I get to some examples, and we're going to talk about herding today, which is when we all sort of group into one investment position. I just wanted to remind you, I guess, for the positive side, my background, and for the negative side, my background. On the positive side, this is what I've done up until now. I've recently launched an independent research firm using technical and behavioral analysis and data visualization. Previously, I was at a large money management firm in the Boston area, and before that, in a market data firm based in New York. If you will look, and I know most of us here are chart users, unfortunately, there seems to be some sort of high correlation between me starting a new professional venture and the market entering into a cyclical downtrend. We've not seen that yet, but if we do see that over the next couple of years, you can come back and either thank me or curse me for providing that catalyst for you. But it's interesting, just as a quick comment, Tom, you had some interesting points about 10-year yields and sort of that sea change we're seeing, where you've seen higher yields now. I'd point out, this is something I've talked with a lot of my peers with over time. Unless you were born before 1960. You've seen nothing in your investment career but a falling rate environment. You've seen a bull market in bonds, and that's all we've all known, which means that most of us in the markets now have never dealt with a bear market in bonds and never dealt with a rising rate environment. I thought about it in my previous role, at Fidelity, looking at any of our new associates. So anyone that's started trading or investing since 2010, you would say, has known nothing but a cyclical bull market. So again, all that means is when something happens and when we have a change in regime and when we have dramatic new leadership, For example, if the FANG trade would completely unwind and small and micro caps lead for the next couple of years, there are going to be a lot of people that are very much caught unaware and unprepared for it, which is why I think charts in a lot of ways are sort of the truth serum for the market. That's what will help you stay on the right side of some of those upcoming changes. So I wanted to talk about herding. And herding, if you're not familiar, it's a behavioral phenomenon where we love to pile into one side of a trade. And a market event happens, a news event, even just a simple move in a market, and so many of us react to it. And if we all react in the same way, we're going to create and propel and perpetuate a phenomenon that you see on the charts. Now, there's ways that this happens in the financial markets and happens with individual stocks, but you'll find it also happens with how you manage your day-to-day life. And I'll share an example using social media. So I was never allowed to use Twitter on the institutional side. We weren't able to for compliance reasons. But since launching my own firm and really even before that, I started getting more into social media, started using Twitter. So I've been on Twitter for probably just over a year now. You can see on the left there, I've built a modest following, putting out comments on behavior and the markets and so forth. What happens though when you use Twitter, for those of you that you do, is every time that you like something or that you follow someone, what you're doing is sort of curating your own feed. And so if I start to follow people that look at charts in a similar way that I do, if I follow people that are trend followers and that are more long-term versus short-term, as an example, my feed will be filled more and more with people that think and behave a lot like me. And the problem with that is if you're trying to break away from your own behavioral biases and get out of a bad or negative pattern, it's a difficult thing to do if all you're surrounded with are opinions that sort of validate your own. It opens us up to all sorts of problems. Now, if you think about it, other social networks that, have a similar issue. So on Facebook, your friends that you link up with, you tend to see opinions that are similar to your own. And we've seen that obviously with political ramifications recently. On LinkedIn, your network and the more that you see and hear from them sort of in some ways defines your worldview. So what I would remind all of you is, as we get into herding and the challenges of everyone having the same investment opinion and putting in bets as a result of that, is you really want to find ways to look at opinions different from your own. So if you're a technical trader in your short term, I would encourage you, number one, to talk to long-term investors, because they're ones that are looking with such a different time frame. Their perspective is going to be very different, and your short-term movements could fit into a much larger context in a way you're not prepared for. If you're very technically oriented, I would talk to people who are not technically oriented, people who trade on some other form of analysis. If you are a long-term investor, talk to people who are fundamentally oriented that don't use a lot of charts. And in my career, I've surrounded myself with those types of investors very regularly. And what it does is it's a reality check on some of the conclusions that you're going to make, and helps you understand how others are coming to their investment decisions. Now, if you look at a chart, I'll show you what herding actually looks like. And again, herding is when we all think of a herd of cattle, all sort of going in one direction. What happens when we all have similar opinions, we all put a similar bet on, we are all on one side of the trade. And if you've ever used an indicator like RSI, looking at momentum, you were essentially getting a read on herding by using that indicator. So when the RSI is overbought, or generally speaking above 70, I would, you can assume that people are moving too heavily on one side. That's why we'd say it's overbought, where people are too aggressively on one side of that market. And as many of you know, just looking at this chart of Interactive Corp, most of the time when the stock becomes overbought, it soon after starts to correct, because the market doesn't go vertical for very long, because eventually people start to take profits, and so forth. On the other side, what we saw recently with IAC is when it sold off due to a corporate event, you saw the stock come down to its 200-day moving average. You saw the RSI become oversold, and we would assume that that's hurting on the downside. People have become very negative on the stock, have sold, and a lot of supply enters the market. The stock sells off, but soon after you see that buyers come into the market. So herding will show itself, and an indicator like RSI, some sort of momentum indicator, and there are others out there, of course, but this is one that I've used the most. You will find when there is herding in play. So in your own investing and when you're looking at charts, herding does not have to be a bad thing, right? So if everyone is going to one side of the trade and you can be aware of that and capitalize on it, now we're doing pretty good work. So in this example, when I saw IAC sell off, and again, we're in earnings season, you saw this with a lot of different charts, but it pulled back to the 200-day. It was oversold. You'll see that third candle when you hit the 200-day is sort of a hammer-like candle with a much longer lower shadow than upper shadow, suggesting that there was accumulation during the trading day. Those sort of things combined to tell me that this was a little too far too quick, and it might be a good opportunity to jump in on weakness on the chart. Now, the last time I was in, which was a couple months ago, I believe, we looked at this slide, which I had a number of questions on. So I just wanted to review it with you because I think it's a really good lesson on what technical indicators you want to have in your own toolkit. So I think of the market in a couple different time frames. We have the short-term time frame, medium-term, and long-term. So the short-term sort of days to weeks. And if you look at what the market tends to do, it tends to mean revert. So in general, you want to be buying weakness and selling strength. On the medium term, which would be, I would think, a couple months to a couple years, the market actually tends to perpetuate, tends to follow trends. So you're better off buying strength and selling weakness over that time frame. Over the long term, if you think of the business cycle, things tend to go back to mean revert. So cycles, sectors and groups come in and out of favor. Now you look at the bottom, the use of fundamental analysis, or I think what you should think about. So on the short term, you really don't need a ton of fundamental work because the markets are much more driven on investor behavior and fear and greed. But on the long term, stocks tend to trade to their fundamental stories and themes. So you want to use more on that side of the equation. So thinking of those different timeframes, let's look at the chart of IAC, and now we'll start to understand how that works. So again, on the short term, if you look at the oversold condition on the right, good entry point for IAC because it had come down so quickly. But now we're bumping back to the last couple years, still looking at daily data, but expanding the time frame a little bit. Now you can see that this chart has really three different periods. So in 2015 through about February of 2016, we're in a bear phase, lower lows, lower highs, and you can see that the RSI frequently became oversold, never really got above the 60 level. And that range, if you've read Connie Brown's work, she introduced me to this when I was studying for the CMT exams. I read that whole theory of it in a bull or bear phase, you want to adjust the overbought and oversold levels. If you look at after the market bottomed here in February, as IAC has rallied over the last couple of years, you can see that the RSI went back into a bullish configuration. So it became overbought frequently, never became oversold, and the RSI really never or rarely went below 40. What concerns me now, if you put this oversold condition into context, is we're now getting back down to that sort of traditional bearish range like we saw back here in 2015, where the RSI frequently gets below 30, it rarely gets above 60. Now, that remains to be seen. This is not saying that this chart alone tells you that IAC is in a bear phase now, but it's showing the signs that it may be starting to enter that. So what I would do with this chart is see if IAC continues to recover, how far does the RSI get, and does it get into the overbought condition, which might tell me that the uptrend may be continuing. But if it stays down in this sort of 20, 30 to 50, 60 range, that just suggests to me that we're in a new phase here. We've transitioned from a bullish to bearish phase. So in this time frame, looking at these couple years, we want to be more trend followers. We want to understand when the overall trend is changing, and then find that overall path of the trend for multiple years. Now, what's interesting, and it's funny, why does herding exist? Why do people pile into one side of the trade or other? And in a stock like Facebook, how and why do trends persist for multiple years, right? And I would say this, having spent a lot of time with institutional money managers, people running, multi-billion-dollar mutual funds, you will find that, overall, broadly speaking, if you think of a technical perspective, they tend to be trend followers because they tend to be a little bit longer term, multiple months to multiple years. So following trends is the right answer for most of them in that time frame. What happens if you're a money manager? Let's assume you run a $20 billion mutual fund. You're benchmarked to the S&P 500, so your job is to outperform that basket of stocks, that index. And you have a stock like Facebook, and in 2014, 2015, the stock continues to go higher highs and higher lows. If you look at the relative performance of Facebook to the S&P, you can see it continues to outperform. The problem, if you don't own Facebook at this point, is you have to go around to all of your clients and justify why you don't own a stock that is outperforming your index. This is a stock in your benchmark. It is a pretty big weighting. It's one of the top 5 in terms of market cap. At this point, I would say Facebook's probably 2% of the S&P, which is one of the largest names. So if you don't own this, it's really hard to outperform. And that's why a lot of institutional money managers have had to be in the FANG trade, because these are big names that are outperforming, and you have to be in them. Otherwise, the hurdles to outperforming are just too great to overcome, even if you have a lot of small cap stocks that are doing well. So what happens is, as we all face this career risk as institutional money managers, we start to think, all right, I have to be in Facebook, I have to be in Netflix, Amazon, these names that are doing so well. What happens when $20 billion fund managers go into a stock like Facebook? That provides more and more demand. That takes supply off the market. That pushes the stock higher. And that's why trends tend to perpetuate over the multiple year cycle. What's interesting now is, if you think about some of the FANG stocks, and that's what we'll look at just to wrap up my portion of the presentation today, is that arguably, if this FANG trade would unwind, or if some of these stocks would not tend to be leadership in the coming months and years, that would be a huge change and would open the door for a lot of mid-cap, small-cap names to have a real opportunity to generate alpha, to generate outperformance. And I think as stock pickers, it could be a really good opportunity if and when that trade would roll off. Looking at the short-term chart of Facebook, what I would consider short-term, it's just looking at daily data for the last 6 to 12 months. We can see that the challenge with a stock like Facebook right now is we've entered what I'd call a supply area. This is where sellers have tended to take profits. This is where, if you're in a long position, you tend to get out. This is where shorts arguably have maybe entered. But for some reason, this price range that we're in is where Facebook has found a top a number of times over the last 6 months. So number one, that concerns me. And unless we break out of that range to the upside, ideally on higher volume, it tells me that it's just not quite there, and that Facebook isn't the leadership yet that we would need to propel us out of this consolidation in the equity markets. RSI, if you look, I've just put a simple trend line looking at the uptrend in the RSI. I'm watching that closely to see if that would break down. It has not yet, which tells you, after the data issues and Zuckerberg's testimonies, the stock has recovered very, very nicely, but we'll see if and when that would break. That would be a concern. The one concern I see otherwise is the MACD indicator, which is a simple trend following device, relatively short term in this case, really, really close or right at a potential sell signal. So that's another thing I would pay attention to. Another chart to think about, Google, just thinking of the other large, sort of tech consumer names in the FANG trade. I wrote a piece on the Top Advisors corner on stockcharts.com end of last year, looking at stocks like Google, Amazon, Apple. These are all stocks that have had this phenomenon. They hit big round numbers, and then they tend to reverse. So Google, coming up to 1,000, hit resistance all through last year. Once it finally broke out, it has tested the 1,000 level a number of times. So the fact that Google's recovered a little bit, that's good. But overall, we're still putting in sort of a lower high. And that is a great opportunity anytime the stock gets back down to that 1,000 level to look at it as a potential, short-term buy. If and when it would break that, that would be pretty negative for the stock. But we're not seeing any sign of that now. But looking at Google, that's the level that I would pay attention to on the downside for sure. And then finally, a chart like Netflix, if you compare this chart to the last two we've looked at, Google and Facebook, you can see why Netflix and Amazon have been the real leadership within those large mega cap names, because it's almost at new highs, very close to breaking out. The RSI is nowhere near overbought, so it still has some upside according to that momentum read. The only concern here is we had this bearish divergence with higher highs and lower peaks in the RSI, but overall it's been very resilient and has held up well. So you compare this chart to the last two, and you'll see why Netflix and Amazon out of that FANG group have really been the leadership, and those are the ones you would look to see if they would break to new highs. I just wrap up my comments. Tom mentioned the dollar earlier, and I think that's a fascinating story. If you think of the weakness in the dollar that we saw up until the last couple months, where we've seen this beautiful rotation, and now I've seen a period of higher highs. I wrote a piece about a month ago on Top Advisors Corner, looking at this breakout on the weekly chart and lining up some Fibonacci levels on the daily chart. What's interesting is we've now actually hit all those objectives that we talked about So in the next day or two, I'll be posting a follow-up article, sort of looking at updated charts on the dollar and what to do now. Now that we've reached those objectives, where do you sort of look? And overall, the quick answer to that is, I think anytime I'm questioning, I go back to the mental checklist, and the very first thing on my checklist is Dow theory. Are we seeing a pattern of higher highs and higher lows, or lower lows and lower highs? And with the dollar, if you look at the chart, it's pretty simple to answer that question. We're seeing a pattern now of higher highs and higher lows. The trend is higher until we see some sort of evidence to the contrary. So thanks. I hope this was an interesting look at herding and some of the ways that manifests on charts, and how to think about an indicator like RSI to help you get ahead of some of that. And at this point, I'll pass it back to Tom and Erin.
Hey, I know I have some questions for you from the chat room that I think are valuable to the discussion based on what we've been talking about. But one of them is about the RSI and the fact that, if it doesn't reach 70 and it's going up and down, do you consider that consolidating? To add on to that, I know for me is if you've got that the RSI pretty much standing above that 50 and moving up and down, not getting past 70, I would look at it more as there's still some internal strength there. But if it starts oscillating below the 50 area, it'd be more like an internal weakness setup. So what do you think about that?
It's a great question, and I think you're absolutely right. The overall levels of RSI and where you find the reversals of it, I think, can be really instructive in terms of what a stock is doing. And at a time when, if we look at an individual stock, it's very easy to put the blinders on and just look at that. But as an equity investor, you really want to understand how this chart and this stock compares to anything else that you could be looking at. And a lot of times we're just looking at the wrong chart. Good analysis, but there are better charts, better actionable opportunities out there. So I think with RSI, if you look at IAC right now, the RSI is right at 50, right just above it, which, by definition tells you we're pretty much right in the middle of the range. There's an absence of real overall momentum overall. The fact that it's improving tells you something about what's happened recently as it's come off the 200-day. But if you look at a bunch of stocks and you look at which ones have an RSI, in the 60 to 70 range or above 70, or the 30 to 40 range below 30, that'll start to help you understand, by bucketing stocks, which names are at which points in their short-term cycle. But I would say you're right, and I mentioned with one of the stocks, or I think it was with Netflix. If you look at what's encouraging to me is, even though the stock is in an uptrend, even though it's near previous highs, the fact that the RSI hasn't gotten to the overbought condition, to me, tells you that this is kind of a healthy uptrend. When it's in the 50 to 70 range, not really becoming overbought, but not getting anywhere in the sort of negative territory, that's a stock, hopefully, is a core holding that you can then build off of. But overall, I think you're absolutely right. The ranges can be really, really informative, especially when you're trying to compare different stocks and different charts.
All righty, let's see. Also had a question. So which do you actually rely on more? The earnings, past and forward, or the valuation ratios like P/E, that sort of thing, when you're deciding which charts to follow? Right?
Great question. And I would tell you this. So your question in some ways actually, I think, justifies charts to a great degree. And if you think about it, based on any work that I've done or that I've seen over the long term, over time, price tends to follow earnings. And if you just think of a chart of the S&P 500 and think of the overall earnings strength of S&P companies, they've been in pretty consistent uptrends over decades, right? So over time, stocks trade to the earnings. If you're in stocks that are, continuing to grow earnings, overall, you're going to be in a pretty good place. The problem is that is not a direct one-to-one relationship. The correlation is not 100% by any means, right? And what I mean is, there are times when the best performing stocks are not the top earners, and there are times when stocks with less than ideal earnings can be top performers. And so using a combination of the two can be very helpful. In answer to your question, what would I use? I mean, I tend to look at valuations on a pretty simplistic basis, because I don't use it as a decision point. I use it as a way to screen. So if I'm looking for stocks that overall are undervalued, I'd look at something like a PE or price to book, depending on what industry you're looking at. But for me, the main thing is the chart, because the chart is going to reflect how the stock overall is trading to the earnings. So again, stocks that tend to grow earnings over time tend to do well, but the chart is what's going to tell you whether or not this is the time to make that bet or whether you want to wait.
All right. And then I think you kind of went over this, but what indicators do you look at to check if the herd has tipped the boat over?
I like that. Yeah. I mean, there's a number of things. RSI is what I've used just as an example here. For me, I like to use things that are standardized. So something like, if you're more statistically minded, anything that's like a Z-score where you're standardizing the data across different stocks. The problem with something like MACD or things like that is, different stocks will have very different values, so it's very difficult to use that to compare a big group of names. But if you look at something like RSI, it's very easy to find. And a frequent screen I do is look at stocks with an RSI above 70, stocks with an RSI below 30. I do the same thing with industry groups. So on stock charts, you've got the Dow industry groups, which is a great list of industries to follow. You can look at, put a list of those with the RSIs on there, and you'll very quickly see what's the leadership and what's struggling. So I think that's one of the best ways to do it. But also remember, another one that we haven't talked about, but you might see with the chart on Netflix we're looking at, is the distance of a stock's price from its moving average. So just the percent above or below the moving average. If you look at how far Netflix got above its 200-day moving average at the end of the first quarter, that was telling you, look how far away it was from the trend, assuming that the 200-day moving average is sort of the average sort of long-term trend. We got really extended from that. And all of that, the only way that's going to happen mathematically is if the stock is at a certain trajectory and then that accelerates, right? Because the 200-day average is an average of the prices, and all of a sudden we're getting further away from that. So another way that that we haven't talked about that I would look at is stocks that are really far above and below their 200-day moving average. And again, that's not a trading system. That just shows you the menu, and then you need to look through the menu to decide what dish you want to order.
All right.
Hey,
yeah, there are a couple of others, but they're a little bit more defined towards stocks. Or if you do have time, though, we'd kind of be interested in your outlook for oil.
Interesting. Okay. Let me bring up a chart here.
And then, Tom, I'll let you get your questions in because I think I've exhausted the chat room pretty well.
So great question. On oil, again, I in some ways, my toolkit is so simplistic. And for me, I like to start with the basics, which is Dow theory. And I have a checklist, not to jump ahead, but thinking of the conference ChartCon coming up in a couple months, I'll be doing a session talking about mindfulness and investing. And one of the things we'll talk about is just having a really good checklist, which is a disciplined way of looking at a chart and deciding what it's telling you. And for me, the very first thing is, are we in an uptrend or a downtrend based on the traditional definition of higher highs and higher lows? There is no denying based on that analysis that oil has been in an uptrend. Looking at I'll look at a weekly chart just to start with here. This is the transition we've had in oil. This is the USO, so not a great proxy because there's some issues in terms of how it's constructed, but overall gives you a good sense of the shape of it. The sell-off that we saw in oil and in the greater commodities space, this sideways pattern that we've had, and this uptrend. One of the things that I thought, as oil really got lower, was a reminder to everyone that once oil is done going down, that doesn't mean oil is just going to go up. That remember, just like we're seeing with stocks now, a market can go sideways much, much longer than we're comfortable with. And that was sort of what I was thinking with oil. Once we sold off, there was no real catalyst telling you it has to go higher. It could go sideways. And that's really what's happened, for the next 18, 20 odd months. But now we've seen a lot of signals that that's changing. And it's not just an oil story. You're seeing it with commodities in general. I think there's been a huge shift of weaker to sideways commodities and now to stronger commodities. Oil, I think, is in an uptrend. And I think in terms of upsides, there's a lot of space on this chart. There's not a lot of resistance that we would bump into for a little while, which tells me that there's room to go. If there's a concern, again, for those of you that are more short-term traders, we've been talking about RSI this whole session, and it recently became overbought. I was looking at the USO, but different ETFs and looking at crude, you've seen it become a little bit extended. So, could you expect short-term weakness? Absolutely, but overall, I think that's an opportunity to get in at a weaker price. The trend is higher and appears to continue to be so.
All right.
David, I know we got maybe just another minute or so, but I wanted to just pull up a chart real quick. And this is a chart. The main line, the black and red line, is the chart of the dollar. And you can see the dollar here over the past month, month and a half, 2 months has really started to move to the upside. And the pink line shows how the Russell 2000 performs relative to the S&P 500. And you can see that normally when the dollar's declining, money rotates more toward the S&P. Now we've got the dollar really moving to the upside. You can see small caps outperforming. Our poll that we've gone over is, or that's up in the room, is whether or not, which area of the market does everyone believe is going to lead the next 3 to 6 months? And I think earlier in your presentation, you indicated that the dollar is in an uptrend as long as it's in an uptrend. So I guess looking at this chart, do you have any thoughts looking out 3 to 6 months, which area of the market you would, most likely be invested in? I mean, are you looking more at small caps? Or are you still sticking more with the larger cap stocks on the S&P or even the Dow?
A great question. And I would say, yeah, the dollar story, I think, is dollar strength until we see something otherwise. And as you've shown, that tends to be good for some of the smaller companies, less than multinationals. And that's exactly what we're seeing, right? If for me, I like to look at, comparing where we're at relative to previous highs and lows. If you think of the January peak in the U.S. markets and look at small cap, micro cap stocks, they're up about 2.5 or 3% above their highs. Right, they've already broken to new highs and have led on the way up. Mid cap stocks are about 2.5% below that high, and the S&P has been the worst. It's down about 5.2 or 5.3%. So in terms of what's happened, small micro caps have led. The larger and large and mid cap names have struggled a little bit on a relative basis, and I think that's a story that will evolve over the rest of this year. If I had to make, if I was answering the poll question, I'd probably pick small caps as the leadership to pay attention to. And again, the FANG trade has been so strong, and I don't see any of the FANG stocks looking horrible. They're going to be okay, but I think as the FANG stocks sort of fluctuate and stay in a general range, there are a lot of smaller names that are going to do much, much better. And that's where an opportunity is going to be. So that trend of small cap outperformance, dollar strength, and relative weakness from the large mega cap names, I think that's a theme that continues for the rest of the year here.
Yeah, it sounds good. I know my chart's not up there right now, but I did notice that in each of the past 2 or 3 significant changes in the dollar, the Russell 2000 versus the S&P 500 actually started reversing its trend before the dollar did. So one of the things I'm looking at is to see if money begins rotating back to the S&P 500, then that could be a signal that maybe the dollar has run too far. But until we see that, it looks to me like small caps are kind of ruling the roost here. And I would be, in terms of answering that poll, I would agree with the majority here that the Russell 2000 leads over the next 3 to 6 months.
Yeah, and just to bring it back to one of my earlier points, I think the challenge with that environment, assuming that is what happens, is it's something that many of us are not familiar with. And if we are familiar with it, it hasn't been the case recently, right? We've had this situation with mega caps being leadership way more than this poll would suggest. And so that I think that's a reminder to everyone to stay true, stay disciplined to your process, and watch where the leadership is. Don't assume it's going to be a certain way just because it has been before. The charts are going to tell you where the leadership is. And again, based on what I'm seeing, I think small cap is where we'll start to see that more and more.
All right. Sounds good. Well, as usual, great having you on the show. Another great presentation. Look to have you back on here pretty soon, my friend.
It's a pleasure, as always. Great to talk to you, and thanks so much.
Yeah, it was great. Thank you.
All right, there he goes. Always great to have Dave on the show, giving his insights on what's going on with the market. Definitely, we're seeing some rotation and all, but for at least now, I would say maybe the last 6-7 weeks, we are seeing that money pour into the small caps and even some of the to a lesser degree the NASDAQ stock. So the top 2 on that poll was I think the Russell 2000 and the NASDAQ, making up about 85% of the poll respondents. So, all right, well, let's go into the 10 and 10. I see you got that set up on the RRG. What do you have?
I absolutely do. The first one, of course, is going to be Motorola. I was looking at the RRG. I think it's pretty interesting at this point. Of course, you got to get in here and take some of these tails down a bit so we can see better. But I noticed there are quite a few of them with that northeast configuration. So I'll probably pick a few there. I do want to caveat, because we do get survey responses, but go ahead and like the symbol request in the chat room. The most popular will be the second symbol. After that, I pretty much hand pick everything. So I do try not to repeat them over the past few days, but I can't guarantee it. If the chart looks really interesting, I'm going to pick it. So in any case, let's go ahead and get started, and we'll see what ones we have in store for you after that most popular one. So go ahead and like.
All right, well, let's start off with Motorola Solutions. I went ahead and annotated this one. I think off of an uptrend, it's sideways consolidating. I think this is very bullish. Overall, volume trend's pretty good. Notice the volume coming in over the past few days as it moves back up toward the top of the range. That doesn't guarantee us we're going to go right through, so I would continue to play this range. But notice that the last time we pulled back and held around 103.5, that was the area we broke out from back in February. So I think this is a range worth watching. I'm going to say 103 to about 112, and we continue to consolidate in that range.
All right. Okay, so our most popular in the chat room, and I have to say I actually own this one, is GE. And I did hop in on that one. We've been bad mouthing it for so long, but it just, that reverse head and shoulders, everything was looking good. Of course, today is certainly on the painful side. So my stop is much lower. So I'm going to be pretty much stuck in here, at least until it breaks below that.
Yeah, the short term certainly looks a lot. Short term looks a lot worse now today, especially with this heavy volume candle. I would be much more bullish if we get a big reversal today and at least hold on to the 20-day moving average. It'd be preferable to hold on to $15 because that was the area where that neckline was. We had the breakout with increasing volume. I'm, along with a lot of others, much more bullish on GE because of its recent behavior. Long-term chart is still down, so I would respect that longer-term chart if the short-term technicals fail. So I would not be happy. I would not be comfortable with a close today below that 20-day moving average, especially with volume picking up. So a little bit of a mixed picture here. I'd be interested to see what happens later in the session on GE.
All right, let's see. The next one I have for you is BURL, Burlington.
Yeah, it's in a great space. I was talking about a lot of the retailers and so forth earlier. While this one is actually down today, I still think it remains in a very bullish pattern. We've got a nice uptrend and kind of similar to the last or to MSI. Anyway, you can see off of the breakout that it had with increasing volume to open up April and to get through the 132.5 level. We got as high as 140, pulled back to 132.5, and you can see that this is the range now that we are in. The closer it gets to 132.5, I have to say, the better I like it from a reward to risk standpoint. So overall, I think it's a nice looking chart, but I like it better as it moves down closer to the bottom of the trading range.
All right, let's see. The next one I have for you is, and I would think this one started off or has a good seasonal look for May, 1-800-Flowers, FLWS.
Interesting. We'll have to see. A lot of times you think that something might set up seasonally very well, like home construction. You think, you go into the spring months, that would be when home construction stocks would do well. But typically, it's actually during the winter months. So maybe we'll look at that seasonal look at flowers.com here in just a minute. But let's pull up the key support level, which to me is 1175. Recent highs up at 13.25. Another one that I think, volume trends look pretty good, but we are still stuck in a trading range. I would probably be careful as we get closer to the resistance area. The other thing I'm not a big fan of here is it does trade below 100,000 shares some days, and that's a little bit of a sign of illiquidity, at least not as much liquidity as I like on the stocks that I trade. So that would be one other consideration.
Okay, let's see. The next one is WLL, Whiting Petroleum. It is the only energy sector one that was requested today.
It's finally getting a pullback, and a well-deserved pullback. I would highlight the reversing candle off the top right there. You've got a bearish engulfing candle, and look at the volume after this stock had been moving up for a long, long time. So I would be watching the 20-day moving average. I think we may have looked at this one just recently because it's looking pretty familiar. But you can see all the tests of the 20-day as the momentum has been building. So I think if we get it back down closer to 47.5, I like it for a short-term trade.
Okay, let's see. Next one will be GERN, and that is Geron. It's a biotech.
Okay, I like the breakout today, and certainly the volume picking up. The only thing that would bother me is if we got the reversal later today and failed to hold that 4.25 level on the close. So if you put a long tail in above these prior highs and go back and close below 4.25, that would really bother me in the short term. Otherwise, though, a close where it is today, I think 4.25 becomes really good support to the downside, and I would maybe look for an initial move up to say about 510 to fill that gap that has not been filled from back in late March.
Okay. Next one, let's see, ARKG. This is an ETF, Genomic Revolution Multi-Sector ETF.
Wow, this is a new one.
Yeah.
Yeah, I mean, it's just been consolidating. It is strengthening, which I like, but it's getting closer to resistance. Here you can see all the support down below 25, 24.75-ish in that range. Multiple tests of that level and holding. And now we are rising. We've got the golden cross. But we saw that back in January just to start the year. And, you know, we crossed back below it. And that's what happens, unfortunately, in sideways consolidations as you get the moving averages that continue to kind of move up and down below each other, above and below one another. I think we're, again, continue to consolidate here. I like the move. So far, holding on to this rising 20-day, which I think is bullish. I give this one a pretty good chance to make a run for 30.5, but I'd be a seller there until it can convince me that it confirms a close over that 30.5 level.
All righty. Let's see. The next one I'm going to give you is Adobe. I thought the chart looked pretty interesting. It's pulling back to some interesting support.
Yeah, Adobe's a great stock, great company. And I'm going to pull this one up in the relative chart style that I use because I think it demonstrates a couple of things. Number one, that let me go ahead and annotate it. The biggest thing it demonstrates is that you've got a great looking stock here, which has been continuing to run higher and higher. I think you had multiple tops that came in about that 230 level. And notice once we got through, we went back, tested 230, and now we're consolidating between 230 and a little above 240. But the overall trend here is higher. And if we go back and take a look here at software stocks, that's higher. Adobe is among the leaders in that software space, has been now for the last several months. Adobe is a great performer relative to the S&P. And you've got software, which has been awesome relative to the S&P as well. So this is kind of the alignment that you really want for stocks if you're trying to outperform the S&P 500. A great stock within a great industry. It's leading its peers. It's leading the S&P, and its peers are leading the S&P. Hard to lose money in that scenario until a trend changes. So as long as this trend stays in play, I think it's a buy and a hold.
All right. Another one that I thought looked interesting where it's pulled back to, it looks like gap support for TRXC. It's medical equipment. I know we were talking about that earlier today.
Okay, TRXC, did I get it right?
Mm-hmm.
Okay, beautiful breakout. We went all the way back down. I know sometimes you break out of this, you know, from $1.50, and next thing you know, you're $5. That doesn't happen very often. Certainly nothing I own ever looks like that. But you know, you think it's never going to fill the gap. Well, you know, a lot of times these will fill gaps. In fact, this one went just a little bit below, probably scared a lot of folks. But it's now trending back higher again. I think we've got had some resistance coming across here a little above $2. And notice that gap up stalled there for a little bit before we really started to make a move to the upside. This is also in that medical equipment space I talked about earlier that I think is very strong. But it does have a bearish engulfing candle. So what I would be looking for here, and this is a pretty wild mover, as you can see. Went from $2 to $3.50 in about 5 trading days. I think it could come back down, test this 20-day moving average. That's where I would be interested maybe in jumping on board. But keep in mind, it is a small company. It is going to be very volatile, and that's not for everyone.
Exactly. All right. This one is rather popular, but I like the way it's heading on the RRG. Also pulled back to, I think, some gap support as well for Boeing, BA.
Yeah, Boeing looks great. I was talking about the aerospace stocks. I can't remember if I talked about them on the show, but I know I've been pointing it out in the blog. I think we got a nice cup that is formed here. There is your high off of an uptrend. The cup formed. The cup looks easier to see. It's much easier to see, I think, on a weekly chart. But if you just kind of connect the highs and the lows here, you're going to see this rounded cup. And I think we're pulling back now. You've got some price support and the 20-day moving average that coincide just about at the 343, 344 area. So if we get back to that level, I think that is a buy point on Boeing. I like Boeing.
All right. And that completes 10 in less than 10 minutes. I think you did really well. From what I could tell, you did really well on, I think yesterday, Tuesday, you went through those really quickly.
Yeah, I think, we were running late, so we were trying to get back on course there. But yeah, this is, it's really I try to illustrate how quickly you can annotate these charts. It's not really about, trying to necessarily get it done in 10 minutes, which would be great, but it's showing you how you can use these annotation tools and save your charts. It saves you so much time when you're going back, if you're building a watch list, to go back and then see what you saw previously and be able to act upon it when it plays out. So I think it's a great tool.
All right. Excellent. And there you go. There are the symbols for today's 10 and 10. I will try and get those up right after the show. And look for look for today's Market Watchers Live blog recap article, and I will also give you the timestamps for our segments today, as well as David's charts. I need to go ahead and get those from him as well. But with that, I think it's time to move on to a discussion very quickly about ChartCon coming up. And there we go. So all you have to do is go to stockcharts.com/chartcon. You'll get all of the information about our online conference that is August 10th and 11th. Yes, you heard me right. It is online. You do not have to travel to come and see all of the amazing guests that we have. Lots of great speakers for you here, including David Keller, who we just heard from earlier. So highly recommend you go ahead and sign up for that. It will work similarly to the way our show works. It will stream live, but you'll also have all of the recordings to look at for the future viewing, and to take notes maybe on some of the particularly good presentations. Martin Pring would be one of them, I would say. So anyway, that's all I have on Stock Charts. ChartCon coming up again August 10th and 11th. And we do have a nice little video there too, to give you some more information on ChartCon, August 10th and 11th. With that, it's time to move on to a market update.
Before you get into that, I do want to mention, Erin, that I looked at the seasonality chart on 1-800-Flowers.
Yes.
May is the worst month of the year.
Oh, boy.
Minus 2.1% on average over the last 20 years. And it's the worst performer. And it only goes up 37% of Mays. So over the last 20 years, I guess that's what, maybe about seven of the last 20 or something like that.
Wow. Interesting. The seasonality is, I really like being able to pull up those charts and get an idea of, typically what these stocks do during which time frames. So
what is interesting, though, is March average is going up 9.6% over the last 20 years, and it's been up 90% of the time. So
we'll see. There you go.
Yeah, it's like it's anticipating, the market is anticipating, the
Mother's Day. And
Yep, exactly.
Yeah, I guess Father's Day isn't a big flower, 1-800-Flowers, such as Mother's Day. All right. Well, again, with that, I'm going to go ahead and we'll move into our market update. And let me go ahead and make sure that this is accurate. So these are 2-day charts so that you know what you're looking at. I believe these are 10-minute or 1-minute bars. I'm not really, I think they're 10-minute bars. Anyway, here we go. As you can see, the Dow is lower. Looked like we had a pretty bad day yesterday, and we're kind of continuing in that vein with a big gap down to start the day, but we're really mostly consolidating right now at those intraday lows. We can see that the S&P 500 is consolidating in a range between 2710 and 2720. Down 9 points right now. You can see the NASDAQ actually looks like it might be coming back to life. I think you could make a case for a possible ascending triangle here. So I'd be watching that closely. Russell 2000, which was having a pretty decent day, is now below its yesterday's close, but it still looks pretty healthy. I'd just be a little bit leery of this double top that we're seeing, although it's not textbook, because remember, these are reversal patterns and we're already in a downtrend. So I find it interesting to look at that double top, but it's not textbook style, as you might say. We can see Canadian markets following the same pathway that the large caps are in the US. Treasury yields, big gap down, but now consolidating, sitting at 3.017%. UUP, big gap up, consolidated, but boy, in the last 10 minutes, it's making another move up to new intraday highs. You can see commodities are mostly unchanged, but have formed a flag in the very short term. We have USO down, currently looking at a symmetrical triangle on the 10-minute bar chart. That could be a continuation, which would mean we're going to look at some lower prices for oil right now. We've got GLD, gold is down on the day, but not down to the degree I might expect it to be, given the really big move in the dollar right now. So that'll be an interesting chart to revisit after the close today. Volatility index is mostly unchanged. We're sitting right at about 13.5. TLT with treasury yields down, as we were talking about earlier. We had a big gap up for TLT, the 20-year treasuries, and it formed a little bit of a double top here, but mostly consolidating sideways after hitting an intraday high, currently reading just below 118 at 117.93. And with that, I think we'll go ahead and move into our next segment. I did want to make a comment, though. I wasn't here Monday, so I didn't get to do my decision point report for you, but you can read Friday's weekly wrap that Carl did. And tonight, I'm going to be writing a DP alert. And those are my all-encompassing view of what's currently happening with the market. And I will be looking at gold and the dollar. So we'll have to see how that ends up today as far as the inverse relationship is considered. And with that, pass back to you, Tom.
All right, I do want to mention too with the dollar that it is currently, the UUP currently at 24.77 is the highest level we've seen since last July. It is above the October and November highs that we saw toward the end of last year. So
there you go.
Fairly significant intermediate term breakout today on the dollar if it holds into today's close.
Absolutely. And look at this 50-200-day EMA is just about ready to have a positive crossover. And that would put me in a long-term buy signal for UUP. Would also, in my opinion, move UUP into that bull market configuration that we want to see. And you can tell it's been well over a year since we've seen that 50 above the 200.
Yep. I've been expecting a big move out of the dollar. I think this could just be the beginning of a really big move to the upside in the UUP, where maybe we go back even to the high back at the beginning of 2017 near 26.75. That'd be a huge move to the upside and would probably lend a lot of support to the notion that small caps will continue to outperform, but we'll see how that goes. All right, it is time to move on. We're going to go into Inside the Lines. We've done this before, and it's a segment where we dive into the technical picture for stocks in the news. And we have had a number of companies that reported earnings last night and this morning. Even though we're not in the midst of earnings season, there were a number of companies that came out. So we're seeing a lot of fundamental news. So I think what we're going to do today is have a little fun and have Erin take a look using the PMO to see what she thinks inside the lines, looking at the charts and ignoring, well, not really ignoring the fundamental news, but really looking at the reaction to the news rather than the news itself. But before we get into the earnings part, there was one company that came out with a authorization to repurchase shares. I think the total was 1.5 billion, and that is MetLife. And we've talked about life insurance recently. So this is ticker symbol MET. What do you see inside the lines, Erin? Is this a buy? I'm not hearing you.
All right, get that back. Sorry about that. All right, so I think these are pretty interesting charts that you gave me, and I will note that of the symbols you gave me, there were 10, so maybe I can do 10 in 10 minutes. We'll have to see if we get to them all. But nice breakout here for MetLife. You can see the PMO is heading up. It's now over 0. We got a bounce on it above the 0 line, so we got a bit of a whipsaw here, but it stayed above the 0 line, and that tells me that there's some internal strength in here. Notice that there was a 20, 50-day EMA positive crossover. So that gives me an intermediate term trend model buy. You can see the 50 is just about ready to hit that 200. So really the only caveat I would have with this is the fact that the 50 is still below the 200. So we kind of need to expect bearish outcomes. But the fact that we're seeing that margin thin out between the 50 and 200-day EMAs, I think that's very encouraging. And then, of course, looking at that strong PMO, you can see OBV looks great. And even the scooter is starting to make a move. So I like MetLife. I think it's sitting on some very important support. It might be a good place to get in there. And I would see the next area of overhead resistance right here at that gap, about $50.
All right, next up is Intuit. They reported earnings last night. Topped expectations on the top line. They beat on the bottom line. They guided their revenue much higher, but they actually lowered their EPS guidance. What do you see here?
All right, so this was kind of an instructive chart, I thought, when I went in to look at it. You can see this, what looks like a horn, I guess, trumpet. These are called broadening patterns, and I don't talk about them very often, but I think it's something to consider right now on Intuit, because when you get a broadening pattern, that tells you the volatility is going to start increasing. And there's some problems as far as, you know, the market is concerned, trying to figure out what to do with this. But I think there's some great signs on here. First of all, we have that PMO is just now turning up. So we might have gotten a little bit of a whipsaw here. If I get that buy signal, I'll feel a lot better. I also noticed in the very short term, notice that the bottoms on the OBV are rising, but the bottoms in that area were actually declining. And that's considered a positive divergence. I think we may have gotten it. It's already sort of played out here with that rally we saw after. But, you know, I think it's interesting. I just always kind of avoid these broadening patterns because the volatility is a little bit high.
Okay. Next one up is Urban Outfitters, URBN. Another company beat top line, beat bottom line. Their gross profit rate increased by 130 basis points over the same period a year ago. What's happening here with Urban?
Rather interesting. It's still in a really strong uptrend. I think that trumps pretty much everything else on this chart. We do have, when you look in the thumbnail, the PMO has topped here, but really the PMO is not really helpful at this moment. It's been very, very flat. And the reason for that is we've been in a steady uptrend. You know, the PMO measures acceleration. Well, as you can see, you know, it put the foot on the accelerator, but it hasn't really you know, increased or decreased that acceleration. It's stayed fairly constant with this nice rising trend channel. We've hit the top of it today, though, and weren't able to get off of that. I would watch it, honestly, to see it come down and test that 50 or the bottom of this rising trend channel. I think you're going to get a bit of a pullback. And I say that based on the fact that I'm looking at the top on the PMO and then look at the OBV as well. So I think this one would be interesting. I'd want to put it on a watch list and see if we can't get it a little bit lower before we go back up and test the top of that rising trend channel. But that channel has been pretty much in force since early February, early March. So I like to see that. Of course, scooter's super high, so you know there's some internal strength here.
Yep. Hewlett Packard Enterprise Company, HPE, top line and bottom line estimates, and they raised their fiscal year 2018 EPS. What do you see in the lines?
This is pretty interesting. So you're telling me they had some really good news today, huh?
Pretty good news.
Yeah, it doesn't look like it. Not good news for those holding the stock, clearly. And you can see what happened to the poor PMO. It just got yanked all the way down. I think noticing the fact that it got yanked all the way down below that previous low, I mean, it's coming down to some pretty important support here. I mean, maybe this is going to be your opportunity to take advantage of a stock that, has been relatively strong. But, you see these drop-offs. I put this Fibonacci here because as I put in these support and resistance lines, I was looking at it, I said, wow, that looks really close to a Fibonacci retracement. So I went in here and look at that. It like almost fits perfectly here. So for those of you, I'm going to thin that out a little bit. For those of you unfamiliar, you can read more about the Fibonacci tool for annotations and how we use it, but mainly you look at it for retracement levels. So what it's telling me is that we should end up seeing it get a bit lower, but the retracement level is going to be back up here to, where we had this interim support, which is now resistance. But that's a pretty nice move there. And we've already taken out most of that space for that Fibonacci decline. So I thought that was rather interesting. Just like I said, I set them up. I don't generally use the Fibonacci tool, but in this case, my eyes kind of just drifted right to it because it fits so well.
All right, next up is CTRP, which is ctrip.com. Beat on the top line, beat on the bottom line. I didn't see anything about guidance, but definitely had beats on top and bottom line. What do you see here?
Yeah, I think this one looks really good. You had this reverse head and shoulders off of a downtrend. So that's textbook style. It's a reversal pattern. And we've gotten the big move off of that. Overhead resistance is still pretty far away. The only thing that I worry about a little bit here is, again, that 50 and 200 day. There's a lot of margin there. Typically, you should expect, again, bearish outcomes, but we actually got the execution of a bullish pattern. So I kind of am not as worried about that as I normally would be. And look at that PMO buy signal came in oversold territory. PMO's not quite over zero, but making that move toward it. And of course, the scooter is really improved. I might watch for a little bit more of a pullback, but I think there's still some pretty good upside potential before you hit overhead resistance at about that 49.50 level.
All right. Next up, Red Robin Gourmet Burgers. And I'm sitting here starving, so this is not a good one to talk about. But they missed by a pretty wide margin on their top line. They missed on their bottom line. Their comparable restaurant revenue down 0.9%. Their profit margin fell. They lowered their guidance. I mean, they did it all. What are the charts telling you?
All right. Well, this was another one that I thought the Fibonacci retracement tool worked pretty well. I'm going to bring this up. And again, it was a matter of just I started drawing these support and resistance lines, and I started to realize we were lining up almost perfectly with the Fibonacci pattern here. So I'm going to pull it away because it is hard to see what's going on since then. But note that the top here is right at that $65 level. It even coincides, it looks like we had that breakout there, but notice the close is still just on that line there. So I thought that was quite interesting. I would expect to see more of a decline. And again, let me get this out of here so that we can see it a little better. Everything is lined up here in about as negative a fashion as can be. You've got a 20-50 day negative crossover in the making here. Of course, we had this huge drop, and we're on some really important support. But this is that falling knife situation, in my opinion. Look at the scooter. OBV bottoms are in decline. There's just not anything here that I might watch it because we are on such significant support here from back in November, but wow. And they had good news or they had bad news? I'm sorry.
Yeah, that was awful. It was awful. Yeah. Everything was awful across the board. We got time for one more, and I want to give you some love here because you set up last Monday, one of your setups or your main setup was Ralph Lauren RL. They beat on their top line, beat on their bottom line, and the stock is soaring. It is now up probably about 23% from where you put it out on your setup last Monday. Great call.
Thank you.
Look at that move.
And you know what? I'll tell you why it even came up on my radar is because I got that move right back here of the PMO turning back up. It got to zero, above the zero line. We were just about ready to get that buy signal, or we had just gotten it. So that's why it looked really good to me. And then look since then, we had all that accumulation. It was really set up. I know yesterday when you were, I think it was Monday when you talked about it, because I did kind of peek in onto the show a little bit, and I had to watch the Monday setups just to see how I did. And yeah, I was pleasantly surprised. And you did mention that we were getting close to that overhead resistance. And I know you don't hold into earnings, but for me, I'm more of an intermediate term trader, and a lot of times I will do that. In this case, obviously, that worked out. But we saw in one of those earlier charts where they beat, and they still just fell off the planet, fell right off the cliff. So I like this. It's clearly too late to get in. I would probably start setting up some trailing stops, because we are looking at a sort of a parabolic going here. But I did want to point out on the weekly chart real quick, and I know we're just about done. I think I had this on a weekly. Yes, there's still, look at how important that breakout was. I mean, that lined up with some serious resistance here. So, may not be totally late to get in on this one, because there's still a lot of upside potential, but I would be watching based on that daily and the probable parabolic there. I'd be a little bit, I'd want my trailing stops in play.
Great. Well, there you have it. Inside the lines. This is a segment again where we try to take a look at the technicals and actually look at inside the lines of the charts, as opposed to necessarily just following the fundamental news. And for some of them kind of lined up with the fundamental news, but others, you would look at them and you'd wonder why the stock is getting hit hard to the downside when it beats top and bottom line. It doesn't really make any sense. So stocks don't always trade the way you might think based on the fundamental reports that come out. So those were the symbols that we went over. And of course, Erin took a look at those for you from her PMO perspective. And great job. Great job.
Thank you.
Welcome back, by the way. Good to have you. Some interesting things coming up, though, you can share with everybody.
Absolutely. Our weekly schedule, of course, continues to be jam-packed as it always is. Friday, we're going to have everything stock charts. We'll learn something new about the website. Memorial Day next Monday, so no show. Tom is taking requests as to what he would like for his workshop to be on Tuesday. And then, sound the trumpets. Mark Chaikin is going to be here on Wednesday. Pass that news along, because that's going to be a great segment as always.
Yep, always great to have Mark on the show for sure. I want to thank everybody for being with us today. Please remember to complete the survey as you exit. We do love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Hopefully see you back here on Thursday, and go Capitals. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.